Now, I'll repeat, shorting the market when you see lower highs and lower lows is not as good of a strategy as buying it when it makes a higher high and a higher low on this key cycle. But let me share with you a pretty good way to short the stock market that uses this 20-week cycle. So in this next section, we're going to talk about the VTLs on the stock market. All right, so let's go back here to 2009, the March 2009 low. We're again tracking this key 20-week cycle in the stock market. I'm going to share with you a pretty simple and yet quite reliable trading strategy for shorting the stock market, and that is using the 20-week low VTL. Now remember, the low VTL connects the lows, and crossing the low VTL means a high of a higher degree cycle has taken place. So let me show you an example right here. Here's a 20-week VTL. Let's make it blue. And what I'm going to show you is that when prices cross the second consecutive low VTL, that is a pretty good short signal for the stock market. Let's highlight all the 20-week cycles that we see here. So obviously we have the March 2009, that's one. Then we have another 20-week cycle low in July 2009, another 20-week cycle low, February 2010, and I think this one is July 2010. So I highly advise you to always construct the 20-week low VTL on the stock market. You should always be aware of where that VTL is located. In 2009, we have this low in March 2009, another one July 2009, another one February 2010, and another one July 2010. So what I just told you is that you should short the second time that prices cross a VTL. So when prices cross the 20-week low VTL 2 consecutive times, that's when you should short the market. What do I mean by this? So let's start with these two lows. The one in 2009, March 2009, and July 2009. I connect these two lows and I draw the VTL. And you can see that prices crossed it sometime in December 2009. You should not do anything with this atlas because this is the first VTL that was crossed. So, and sure enough, prices actually did go down a little bit, and they traced out another 20-week cycle low in February 2010. So now we have our first VTL that was crossed. Now we're going to draw the second. Boom. And when the second consecutive VTL is crossed, that's when the market actually suffered a correction. And this is quite reliable. I'm going to show you all the instances where this happened, going all the way through to 2023. For this pattern, you're going to need 2 consecutive 20-week cycles, and you want the 20-week low VTL to be crossed on both occasions. All right, and the first one you're going to ignore, and the second one you're going to act upon. We have our first 20-week cycle here. These black arrows are just tracing out the path of the 20-week cycle. Once we have a completed 20-week cycle, we create the VTL by connecting the two lows. Bam, that's our first VTL. And you can see that it was crossed over on this arrow that I'm going to paint red. And this is the first VTL that was crossed, so we don't act upon that. But then the 20-week cycle went on to do this. Went up, went down. Now we have a second completed 20-week cycle, and we're going to draw the VTL on that. We draw the VTL, and bam. You can see we have 2 cycles, and in both cycles, prices cross below the 20-week low VTL. And on the second time, you can use that as a signal to short the market. Now, this is a bit of a weird pattern, but let me show you 2008. Here's the top in 2008. And again, let me show you the 2 consecutive VTLs that were crossed in 2008, because this is, once you get used to this strategy, it's quite simple. So here's our first 20-week low. Prices are rallying into a 20-week high. then selling off into a 20-week low. So okay, we have a completed cycle. We can draw the VTL here. And you can see that prices are crossing it around this black line right there. Now this is the first VTL that was crossed. Prices described another 20-week cycle here. All right, so now I draw the second VTL. And I connect the two lows. Draw the second VTL, connecting the two lows. And bam, this crossing of this second consecutive VTL kicked off the entire 2008 market crash. Here's another example. This is 2011. And we have a 20-week cycle here. This is according to the filters. Boom, boom. First completed cycle. We draw the VTL right there. This is our first time that prices cross the VTL. And this is the next 20-week cycle here. So we have two 20-week cycles, and the first of these VTLs was crossed. Then we move on to the next 20-week cycle. We draw the VTL for that. And we see that it was crossed around here in August of 2011. And again, it's a pretty neat, reliable short signal. Personally, I think it's much better to use this, call it 2 consecutive VTL rule, than waiting for a lower high and a lower low on the cycle. You usually get much better signals. Now that doesn't mean you should stay short forever, but you can reliably make 9–10% on the stock market in a few short days when these 2 consecutive VTLs get crossed. Now let me show you what happens when you don't have the 2 consecutive VTLs being crossed. So here's a 20-week cycle. It ends here. If I draw the VTL, it was crossed once. If I highlight the second cycle and I draw the VTL, I get this. And prices never really crossed this downtrend line. So you can see that when prices just cross the first VTL, doesn't mean much. On the next example, we have this. And we start from here. This 2015-2014 period is quite murky. It's difficult to see. Here we have our first cycle. We draw the VTL. Prices cross below it, but it doesn't mean much. We're waiting for the second one. The second cycle is it's this one. I've drawn this first cycle. It's VTL, prices cross below it, but it's just the first one. So now I draw the second cycle, which according to the filter is right here. There you go. And then I draw the VTL. Prices cross below it here. And you can see that if I sell the market here, and let's say I use the last 20-week cycle high as a stop loss, right there, I get challenged on this position, but prices eventually actually do fall. So it's this second consecutive VTL rule that I find to be quite reliable. So here, the last example that I found of these 2 consecutive VTLs being crossed is late 2021, early 2022. In 2021, we don't really see the 20-week cycle. However, we can just connect the last 2 visible 20-week cycles and construct a VTL. We have October 2020 as a 20-week cycle. You can see the filter doesn't actually go down until September of 2021, a whole year. And that's okay. This technique still works, and you should not bother trying to find more 20-week cycles if the filter is not moving. So here's our 20-week cycle, connect the VTL. And guys, you should always be aware where this VTL is. Throughout this entire period, even if prices never cross below the VTL, you should still draw it and you should still be aware of where it is. Now here's the first one that is crossed, first VTL. When one VTL gets crossed, that is a warning. It doesn't mean prices are going to fall. It is a warning that they may. For that, you need to wait for the second VTL. So here's the second 20-week cycle. There you go. And now let's see if prices crossed the second consecutive VTL. And sure enough, they did. They crossed it around here. And you can use that as a signal to go short. Now, just an extra little tip. Instead of if the VTL is pointing down, instead of the VTL, you can use the 20-week cycle low itself. Both are fine. If you're comfortable using just the VTLs just for consistency, that is fine. But if the VTL, if you notice that it's pointing down, you can also use the 20-week cycle low itself, and crossing below that could act as a replacement for the second VTL. That's a pretty simple technique to short the stock market using consecutive VTLs. The reason you're using two and not just one is because the stock market tends to roll over slowly. It has these rounded tops. So you really want two VTLs to be crossed consecutively, not just one. When two consecutive VTLs get crossed, that means the market is probably ready to fall more significantly. This is why I like this technique. So what about using VTLs to pinpoint the end of downtrends? For that, you can use a single VTL. And the reason is the stock market likes to make these rounded tops, but it makes sharp lows, or V bottoms, they're also called. And so for that, you don't need to wait for two VTLs. And just to show you an example, let me show you the example of 2011. You can see the two consecutive VTLs being crossed. Your short signal is somewhere in here. And so how can you use VTLs to pinpoint the low? Well, yes, you could. You can use the high VTL right there. And when prices cross above that high VTL, the correction is over. Now, obviously, if you're going to short the stock market, I don't recommend you use cycles as an exit. I recommend you just use a flat out, 5-10% profit target and exit after that, because corrections tend to be quite sharp but brief. So I would not use any cycle indicators to exit a short position. I like to use the VTLs to enter a short position, but my exit is just as profit target. The stop loss should always be above the last 20-week cycle high, because your thesis or your theory when you're shorting the stock market is the market is going to make lower highs and lower lows on this 20-week cycle. So the 20-week cycle high acts as a natural resistance level that should not be crossed at any moment. One final note on VTLs and using high VTLs instead of low VTLs. Let's say you're in 2008, you went short on the double VTL rule, you shorted the market a bunch of times because the 20-week cycle was still making lower highs and lower lows. And once you have a confirmed bear market, once you're in that setup, something that looks like what you're seeing on the screen, the 2008 financial crisis, you can also use the 20-week cycle VTL, the high VTL this time, to pinpoint the end of the bear market. And I've used this quite reliably. It works pretty well. The black arrows are going to highlight what the 20-week cycle is doing, late 2008. And you can draw this first VTL here. Not very useful. But if we draw the second one, now it is. When prices cross above that VTL, it is a pretty early signal that the bear market may be ending. Now, it's not a short signal. So for me, I would use a double VTL rule for shorting the stock market. But if I want to buy the stock market, you're better off waiting for prices to cross above the last 20-week cycle high. So prices cross above it around June of 2009. Just to recap, for shorting, I would use the double VTL rule, but for going long, just wait for prices to cross above the last 20-week cycle high. And that's a pretty good trading strategy on the stock market using this key 20-week cycle high. I hope you understand why I like the 20-week cycle so much. It's because you can devise some pretty simple trading strategies around that cycle. And even if you're completely unaware of what the 18-month or the 54-month cycles are doing, you can still just use VTLs on the 20-week cycle or just the highs and lows on the 20-week cycle to create a pretty simple trading strategy. Feel free to make this your own. There's plenty more you can do within the stock market, but like I said, this is not a comprehensive guide of all the things you could do with it.